Picture this scenario for a second.
Wow.
You're a successful corporate professional, right?
Right.
You've spent years navigating the corporate hierarchy. You have a really solid income, but you are just tired of the rat race.
Oh, absolutely. That burnout is real.
It is. And you're looking for an exit strategy, something that gives you control over your own time and, your own equity. So naturally, franchise ownership enters the chat.
It's the logical next step for a lot of people.
Exactly. But then you start looking at popular models, and man, the initial investment for a massive physical footprint is just terrifying.
It's a huge hurdle.
And if the capital requirement doesn't make you pause, the staffing requirements definitely will. I mean, some of these business models require managing a rotating schedule of 40 or 50 hourly employees just to maintain basic operating hours.
Which is a full-time job in itself.
Right. So what if there was a model that completely flipped that script? Today, we are doing a deep dive into the business model, the unit economics, and the growth strategy of ATAX. They are a full-service national tax preparation and business services franchise.
And this is such a highly relevant case study for the current market right now. ATAX operates in the accounting and tax services industry,
Right.
but it serves as this prime example for aspiring buyers or, multi-unit expanders,
Yeah.
and especially semi-absentee investors who are evaluating scalable, community-focused businesses. Because we are looking at a system that is engineered to maintain a very lean operational footprint while still building long-term equity.
So for you listening right now, whether you're actively vetting franchises or you're just fascinated by the mechanics of highly efficient business models, we're going to unpack exactly what makes this low capital, high retention structure tick. Because before you can even look at the services a franchise offers to a community.
You have to figure out if you can afford to turn the lights on.
Exactly. You have to look at the financial footprint required to get the doors open. Okay, let's unpack this. Launching a typical brick-and-mortar franchise with massive real estate and equipment requirements, well, it's a bit like custom building a mansion before you've even met your neighbors.
That's a great way to put it.
You have this massive upfront cost, significant capital tied up in construction and physical assets before you generate a single dollar of revenue. But the ATAX model operates much more like, say, moving into a turnkey apartment. The initial investment range is between $59,150 and $79,000.
And that entry point dramatically shifts the liquidity requirements for a prospective buyer because the actual cash requirement is just $35,000.
Wait, really? Just $35,000?
Yeah, just $35,000. And when you analyze franchise buyer psychology, that specific number changes the entire risk profile of the decision. A $35,000 liquid capital requirement means a corporate professional often doesn't need to, liquidate their entire retirement portfolio or take on these complex, heavy commercial loans just to reach opening day.
Right. It preserves their working capital.
Exactly. Rather than sinking cash into heavy machinery or some elaborate retail build-out, the franchise can deploy those funds into hyperlocal marketing, client acquisition, and eventually
Funding their second or third territory.
Precisely. It accelerates the multi-unit growth timeline.
Now, they've also been operating since 2007, and they currently sit at about 120 units. Plus, they offer a 10-year renewable franchise agreement, and they have veteran discounts available too.
Which is a solid foundational footprint.
It is, but we do need to examine the ongoing operational costs, right? Because that is where the unit economics are actually tested in the real world. The franchise structure includes a 14% royalty fee and a 3% ad royalty. And 14% is a figure that will immediately make a prospective buyer stop and ask, what exactly am I paying for every single month?
And that is the exact right question to ask. But to understand that royalty structure, you really have to look at the underlying cost of goods sold.
Okay, walk me through that.
Well, in a franchise that relies on physical inventory, the margins on the actual product are often quite narrow because you are constantly purchasing raw materials.
Like buying food for a restaurant.
Exactly. But in a professional services model like tax and accounting, the primary product is intellectual capital, it's time. So the inherent margins on the service itself are much, much wider.
Ah, got it.
The royalty fee is funding a very specific corporate infrastructure designed to protect those wider margins. ATAX maintains a lean corporate headquarters team of 5 employees.
Just 5.
Just 5. But those 5 individuals share over 140 years of combined industry experience.
Oh, wow. That's a lot of institutional knowledge.
Right. So the local franchisee is basically paying for a concentrated brain trust. They are funding the back-end compliance, all the legal updates, the operational software, everything required to safely navigate a highly regulated financial industry.
That makes a lot of sense. So you aren't paying for supply chain logistics, you're paying for regulatory armor, basically.
That is a perfect way to describe it, regulatory armor.
But the metric that really demands attention here is the local staffing requirement, because the model is designed to operate with fewer than 5 employees to start.
Yeah, less than 5.
How does a team of less than 5 people actually handle the volume required to scale a financial services business? I mean, that seems incredibly lean.
They manage the volume precisely because of that corporate brain trust we just talked about.
Mm-hmm.
The local team isn't tasked with building compliance frameworks from scratch or researching obscure tax code changes on their own time.
Right, the heavy lifting is done at corporate.
Exactly. The back-end systems are provided, which allows a lean local staff to focus entirely on client intake, data accuracy, and relationship management. And for the semi-absentee investor, keeping the headcount under 5 highly skilled professionals is just the ultimate operational leverage.
Because managing people is the hardest part of any business.
Absolutely. Managing a massive hourly workforce requires a huge dedicated human resources effort. The hiring, the scheduling, the training, it constantly consumes an owner's bandwidth.
Yeah, you're constantly putting out fires.
Right. So a small professional team drastically reduces that labor friction. The owner steps out of the role of a daily shift manager, and they step into the role of a strategic business developer. They can actually focus on community networking and multi-unit expansion.
Okay, I see the appeal of a lean staff. But wait, aren't we talking about a fundamentally seasonal industry here?
The seasonal question.
Right. I mean, the traditional perception of tax preparation is a frantic sprint from January to April and then followed by a total dead zone.
Mm-hmm.
How does an owner keep a team employed, cover their real estate lease, and actually generate consistent profit from May to December?
That is the big misconception. Relying solely on a 4-month revenue window is a totally outdated model.
Okay.
To engineer a service-based business that absorbs seasonal fluctuations, you have to pivot. You pivot from being a purely transactional, once-a-year tax preparer to becoming an integrated year-round financial partner.
And how do they do that?
Well, it requires a specific service stack designed for continuity.
Let's look at that service stack then. ATAX positions itself with 5 in-demand core services: personal taxes, business taxes, bookkeeping, payroll, and incorporation services.
Oh, and they also handle ITN applications.
Right, which is crucial. Yeah. On the individual and family side, it's not just filing a standard 1040 form in April. They handle IRS audit support, prior year filing, and amended returns. Because people get audited or realize they need to amend a past mistake in, like, August or November.
Exactly. Life happens year-round.
Plus, they offer those ITIN applications, individual taxpayer identification numbers, for free.
And offering free ITN applications is such a highly strategic gateway service.
How so?
It establishes immediate goodwill with individuals who are actively trying to formalize their financial footing in the United States. You're helping them navigate a complex system for free.
Right.
But to truly decode the year-round economics of this model, we have to analyze the business-to-business side, B2B offerings.
Right.
By providing quarterly filing help, business incorporation, bookkeeping, and payroll services to local small businesses, the franchisee fundamentally alters their cash flow trajectory.
Here's where it gets really interesting. When you shift from filing a personal tax return once a year to managing a local landscaping company's payroll every 2 weeks, or handling the monthly bookkeeping for a neighborhood bakery, your relationship to that client changes completely.
You transition from a seasonal vendor to an absolute operational necessity. And in financial modeling, this creates monthly recurring revenue, or MRR.
The holy grail of business.
Right. And for a corporate professional, leaving the predictable environment of a biweekly salary, revenue volatility is the largest psychological hurdle to business ownership.
Oh, for sure. The fear of months with zero income.
Exactly. So B2B services like payroll and bookkeeping establish a baseline of predictable and recurring income. That baseline covers the operational overhead, the lease, the lean staff throughout the entire year.
So what happens when tax season actually hits?
When tax season arrives, the revenue generated from personal returns acts as a significant profit multiplier. It's not just survival money to get you through the summer anymore.
So that makes so much sense. It functions almost like a localized subscription model.
Exactly like that.
I mean, imagine a new entrepreneur walking into the office in June. The franchisee helps them legally incorporate their business. Naturally, that new business needs someone to manage their books, so the franchise takes on the monthly bookkeeping.
Yep.
A few months later, the business hires its first 2 employees, and the franchise steps in as the payroll provider. When tax season finally rolls around the following spring, that business owner isn't going to go shop around for a random tax preparer.
Why would they?
Right. The franchise already possesses their pristine, organized financial data.
And that's the key. The switching costs for the client become a massive retention tool. Migrating historical bookkeeping data or payroll systems to a new provider is a painful, time-consuming process for a small business owner. Nobody wants to do it.
No, it's a nightmare.
So if the franchise delivers consistent, accurate service, that client remains in the ecosystem for the lifespan of their business. And this predictability is what makes multi-unit growth a mathematical exercise.
How do you mean?
Once the first location secures a stable portfolio of B2B recurring revenue, the owner can forecast exactly when they'll have the capital to open unit number 2, and then unit number 3. It removes the guesswork.
Okay, so we've established the unit economics and the year-round B2B revenue mechanism, but let's look at client acquisition. Because the financial services market is incredibly crowded.
It is very competitive.
You have massive legacy software companies spending millions on national Super Bowl campaigns, and you have established independent mom-and-pop shops in almost every market. How does a new, locally owned franchise location actually capture market share?
They capture market share by refusing to play the mass market game. The brand utilizes what they call a proven guerrilla marketing strategy. It basically bypasses broad, generalized advertising in favor of hyper-local community embedding.
Okay, looking at their materials, they emphasize locally owned offices where clients are met with a smile and treated like family. The messaging specifically highlights a completely judgment-free environment, regardless of the client's current financial reality.
Which is huge for trust.
And the most striking element here is their multicultural focus. They actively promote bilingual tax preparation. Across their network, locations offer services in an extensive range of languages: Spanish, Chinese, including Mandarin, Cantonese, and Shanghainese,
Yeah.
Filipino, Portuguese, Creole, French, Italian, and Vietnamese. Plus, they run a community initiative called ATAX Cares, where their experts actually speak at local schools and support community causes.
And those linguistic capabilities right there are the engine of their client acquisition strategy.
I need to challenge the actual return on investment of that strategy, though.
Okay, go for it.
Because, anyone can put a tax help sign in a window, and anyone can print flyers for a local high school. How does speaking Shanghainese or hosting a seminar at a community center actually outpace a targeted digital ad campaign by a giant software firm?
It outpaces digital spend because of the specific psychological friction associated with financial services.
Meaning what exactly?
Meaning money, taxation, and dealing with the IRS are universally stressful touch points. For many individuals, their financial history carries a real sense of vulnerability or confusion.
Nobody likes dealing with the IRS.
Right. Now, compound that inherent stress with a language barrier. An immigrant family or a first-generation business owner trying to decipher the American tax code in a second language, they face a monumental wall of anxiety.
That sounds completely overwhelming.
It is, and a targeted digital ad cannot alleviate that anxiety.
Especially because the stakes are incredibly high. Making a mistake on your corporate payroll or your personal taxes has severe legal and financial consequences. You are literally handing over your livelihood to a stranger.
Exactly. So when a franchise opens an office and provides a sophisticated, judgment-free financial service in the client's native language, they remove that wall of anxiety entirely. They decode a complex, intimidating system for them. And this creates a localized network effect, a family that finally understands their financial standing because it was explained patiently in their primary language. They become an active advocate for the business. They refer their extended family, their coworkers, the other small business owners in their cultural network.
The historical data really backs up this trust mechanism, too. The franchising arm launched in 2007, but the consumer-facing brand has actually been operating since 1986.
Decades of proof.
Yeah, decades of client testimonials that consistently highlight themes of the service being stress-free, professional, and patient. The reviews don't just focus on the speed of the transaction, which is what software does. They focus on the staff actually taking the time to explain the process.
And that level of community integration builds an impenetrable competitive moat. A national chain utilizing temporary seasonal preparers, they really struggle to build multi-year relationships.
Yeah. And a purely digital software solution cannot sit across the desk, look a client in the eye, and map out a payroll strategy in Creole or Portuguese. This hyperlocal trust drives organic, community-led growth.
Which has to be cheaper than buying ads.
Oh, absolutely. Over time, this significantly lowers the customer acquisition cost. When your clients are actively recruiting new business for you through their own community networks, those marketing savings drop directly to the franchisee's bottom line.
So what does this all mean? We have explored a pretty comprehensive operational model today. It starts with a low barrier to entry that preserves working capital.
Right.
It utilizes a highly experienced corporate brain trust to allow a lean local staff of under 5 people to handle complex compliance. It generates monthly recurring revenue through B2B payroll and bookkeeping to totally eliminate that seasonal panic.
Yep.
And it drives growth through deep multilingual community trust rather than expensive mass marketing. It presents a very clear strategic pathway for the right buyer profile. Evaluating an opportunity like this requires understanding not just the initial investment, but the daily operational reality and the long-term equity potential.
It definitely requires thorough due diligence to determine if a low overhead, community integrated model aligns with your personal and financial objectives. It's not for everybody, but for the right person, it's powerful.
It is. And as you continue evaluating different business vehicles, consider this perspective on wealth creation. We are frequently conditioned to seek out flashy concepts, right?
Oh yeah, the trendy stuff.
Disruptive technologies or the latest consumer trends when planning an exit strategy or a business venture. But what if the ultimate scalable asset is actually the opposite of flashy? What if true multi-unit financial freedom comes from simply becoming the quiet, indispensable operational backbone of your local community?